Good evening, everyone. On behalf of Phillip Securities, I would like to welcome you to tonight's webinar. My name is Darren, and I'll be hosting you tonight. Now, before we begin, I would like to turn your attention to our Cyber Monday giveaway on Instagram, where you will stand a chance to win free C, BABA, and JD shares. For more information, you can scan the QR code that is on your screen right now, or you can click the link inside the chat if you're on your mobile phone. I just sent the link inside. One thing to note, there will be a Q&A session after the presentation. You may direct your questions during the presentation into the Q&A section. Please do so rather than in the chat so that the presenters, we can actually see the questions that you are answering. You should be able to find the Q&A button at the bottom of your screen. Okay, now please allow me to introduce you to your speaker tonight, Mr. Gregg. He is a senior product specialist at First Trust Global Portfolios, and he has been immersed in the ETF industry for over 10 years. He frequently engages with industry experts and clients on a wide range of topics, including popular industry themes such as thematic investing and smart beta. And he's here tonight to share with us e-commerce investment opportunities and why it is far beyond just our online shopping. Now I would like to hand over the time to Mr. Gregg. Mr. Gregg, please.
Well, thank you. I really appreciate that. And I really appreciate the opportunity to be here. The idea of getting free shares sounds like one of the coolest giveaways I've ever heard of in my life. I wish I could participate in that. That sounds very cool. So whatever you all have to do to win shares of those incredible companies, I would strongly encourage you to do so. Now, just real quick, I was going to share a presentation. It's just saying there we go. Excellent. So I'm really excited to be able to be here today and to talk through this idea of Cyber Monday and particularly e-commerce. I think one of the things we're seeing this year is that the e-commerce market is just continually set to grow. There was a note just the other day, Adobe predicts that a record $200 billion are going to be spent online. Again, now, interestingly, higher prices and smaller discounts. I hope somebody asks a question about that. That actually comes to the power of being digital, which is actually a good thing for the stocks that we're buying, right? Maybe not a good thing for the client or for us heading into the store. But I don't know if you guys have had this issue. And this is really important, actually. I'm jumping in right away. We talk about thematic investing as nuclear submarines in a sailboat world. Let me just draw that real quick. The reason why I talk about that is in a sailboat world, you've got your company up here, you've got your sail, and there's headwinds and there's tailwinds, right? But if you're a nuclear submarine, you're down here below the water, you're going wherever your engine wants to take you. It could be a hurricane up there. It could be sunny skies. You're going to go as fast as your nuclear engine can take you. And that engine is the sails of your particular theme. And so we believe the digital adoption is completely in revolution mode. We are growing rapidly, and we're actually at this point in the curve starting to tip up. We're actually growing faster. Great book on the subject is called The Future is Faster Than You Think. I strongly recommend it to you all. Now, one of the other things I was going to say is that because of being digital, you allow people to compete more clearly, and you don't need to engage with customers in the physical barriers that you have. Let me explain what that means. So Cyber Monday is a great day. It's on Monday. Cyber Monday is a great example of why Black Friday has now become Black Week, right? So Jasmine and I live here in the UK, and they've had Black Friday sales for 2-3 weeks for some of these companies. Now, the reason for that is the internet. Right? The whole point, I just want to take us back. So Cyber Monday is prior to Black Friday. So what happened is on Black Friday, you had all the physical brick and mortar retailers for years. I mean, go back to National Lampoon's Christmas Vacation. They go to the stores after eating the turkey. And so when we're sitting here, you've got Black Friday is a day after Thanksgiving in the United States where most people don't have to go to work. And because they don't have to go to work and they're with family, they need something to do. So they go Christmas shopping. And I'm not trying to be patronizing. I know you all know this. I think this is a really important point to draw out what we're going to be talking about today. That in order to incentivize somebody, you have limited hours, finite time, say 8 hours, right? And you have limited length you can go. I can't just go from one store in Milwaukee to another store in Chicago. So I'm at this particular part of the city. I've got X number of hours and we're going to go. In fact, families have been splitting up and heading to different stores and getting suitcases here and things like that. It's been a fun little trip the last couple of years. And the internet made that even possible, but I'm getting ahead of myself. So Black Friday comes, right? And I need somebody in my store, because if they're not in my store, they're in somebody else's store buying their thing, right? Price competition is very difficult. So what they would do is they would say, we're going to give away 5 amazing televisions for $200 or $100. First come, first serve, or 5 PlayStation 2s, or whatever the thing is of the moment, right? We're going to have all these DVDs for $1. Okay, and they want you in their store, because once you're in their store, you're likely to buy lots of other things. They only have to lose money on that 1 or 2 televisions, and then other people are in there getting things as well. And they have to compete because other people are doing it. It's kind of like an arms race, right? So if they're going to be at 20% off, then I got to be at 20% off at least, if not more. Or I have to have a better indoor sale, or called doorbusters, things like that. Now, that would happen. And then they would realize that people would be at their desks on Monday, and companies like Amazon and any of those brick and mortar retailers like Best Buy or others that realized they were also competing, still left over from what people didn't buy, they would do these Cyber Monday deals. Now, this has had a fascinating ramification, because as the world has shifted from brick and mortar sales into e-commerce, leveraging the foundational technology of the internet, we've gotten this unbelievable online shopping world has allowed the brick and mortar retailers to elongate, and so by competing in a longer time frame and much more transparency, I know that, say, John Lewis is selling their television at $1,000, so I'm only going to sell mine at $1,000. They've been able to protect their margins, even the brick and mortar retailers, because of the internet. I hope that wasn't boring. I think it's a really important point that Cyber Monday gives us a quick, brief history into the power of the internet to just change wholesale the landscape of a particular thing. Something that people have been doing for decades, shopping in a store, is now completely different and is having a lot of different benefits and causes and costs. Now, one thing I wanted to be very clear. When we were asked, can we do a presentation on e-commerce? I said, sure, but I wanted to make it very clear. I know that we're talking about Cyber Monday. I believe in e-commerce as a much more broader narrative than just online shopping. And so when we come here, we just want to give you a brief introduction to the internet indexes, both in the United States and around the world. Quickly talk about the power of thematic investing, and boy, oh boy, is there an opportunity remaining. And the reason all of this has been made possible, any of the things we're about to talk about inside of e-commerce have been made plausible by internet technology. The internet lowered the cost of connection, and it's allowed people to sell something to someone else much, much more quickly and efficiently. And the scalability of that is unbelievable. In particular, if it's a digital product or service, okay? So if it's a digital product or service, say a Netflix streaming account, they can get 10 million more people getting their service right away. Okay, so even selling a physical product over the internet allows a much more efficient way to do that, and allows you to sell it anywhere in the world, but you still have to get that physical product to the people. Now remember, e-commerce. Commerce doesn't just mean shopping. Commerce means all sorts of business. And so what we're going to talk about today is all the ways the internet has enabled selling something to somebody else. And here's the way we'd like to start.
Human history is a story of ingenuity and innovation, from the invention of the printing press and the internal combustion engine to the Industrial Revolution. But nothing has impacted the world like the internet. It is perhaps the greatest infrastructure for innovation in human history. And we are again in the midst of another technological revolution built upon things like cloud computing, cybersecurity, and blockchain, all deployed with lightning-fast connection speeds. From banking to communications, charity to warfare, the internet continues to transform our world. As industries like healthcare become online services, as social media connects us with each other and consumers with their brands, as our emails and menus are translated accurately in real time and computing power becomes a cloud-based utility, the benefits are clear, but so are the additional risks. While it is so much more efficient to not have to go physically to a bank and queue, we never really were worried someone was going to steal our bank account, much less our entire identity. With new innovations come new problems, which demand technologies like cybersecurity and blockchain to continually generate new solutions to combat these digital risks. Not only does the internet facilitate the fastest adoption rates the world has ever seen, it can also deliver products and services with greater transparency and lower environmental impact. Taken together, cloud computing, cybersecurity, and blockchain all wirelessly provide the infrastructure for the future of global innovation, facilitating a faster, greener, safer world, an investment in the future.
Excellent. Now we're going to get to jump right in here. And one of the things we're going to be able to talk about at the end is actually C Limited. C Limited is one of my favorite stocks to talk about in the entire world. And I'm really excited. But if we just kind of look at something like this, oh, and sorry for the Italian subtitles. That's the most recent use of the video was in an Italian conference. But just think of how much time we spend on the internet. It's unbelievable. All of these things that happen in just a minute. And this is, you could look this up. It's on a company called Domo. How much data is generated every minute? Let's just pick one of these things. 400,444 minutes of Netflix is streamed. Just ridiculous. Now, we've been doing thematic investing for 25 years. We've been founded as a business for 30 years, and we've got over $30 billion in thematic assets, actually 35 billion in thematic assets and thematic products, about 35 products as well. Now, this is our thematic range as it relates to the UCITS business. We've got both a UCITS platform and a US platform. Doesn't matter, the same tickers and the same funds are available in both markets. So depending on where your client might be domiciled, that could be of use. FDN, the Dow Jones Internet Index Tracking ETF, is the index that tracks the US internet stocks, and FDNI is the portfolio that tracks non-internet related or non-US listed internet related companies. When you buy thematic investing, this is very important to set the stage and why I'm going to talk so much about particular securities. You get a more pure exposure to the theme. When we first brought out our internet index, the exposure to Amazon and Google in our fund was 20%, 10% each of those. In the S&P 500, I believe it was a total of like 20 or 40 basis points to Amazon and Google. I think we all know how that went, right? In fact, I'm going to show you data on the internet index that goes back to 1997 that it just blew my mind to see, in spite of all the things that happened, the winners helped so much that the outperformance is just unbelievable. Now, this is one of the most important things that thematic investing can do. It breaks your sector bias. Tech investors that bought, say, something like, I can't tell you the ticker symbol, but something like the S&P 500 technology ETF, one of the most famous ETFs in the world, it never owned the following companies: Amazon, Netflix, Google, or Facebook. Never. I'm sorry. Maybe it might have owned Google, but it never owned Amazon and Netflix because they were in the consumer discretionary index. And now none of them are in this. That's what it was. Now, they used to be tagged as IT, but now none of them are, because Facebook and Google are now in the communication services industry. Companies that you may know, obviously, are Alibaba and Tencent have also never been categorized as as information technology securities. So we just find it so interesting that with all this innovation and ETFs worldwide, that people continue to buy technology ETFs. And just checking right now, C Limited is communication services. So C Limited isn't even tagged as a technology security, but we would all count that. Now, then it gets to this stock exposure. And I'll show you a slide on that. When we owned Netflix, it was a meaningful allocation of 1 or 2%, but it climbed the ranks very quickly. But when we had it at 2%, it wasn't even in the S&P 500. And many people didn't even know about it in 2008. So what we have here is you tend to get companies you know about with an overweight. So, thematic investing also gives you companies that are tied to the theme, whether you like it or not. And one of the things you're going to see, we're going to be overweight Tencent and Alibaba because they are behemoths right now in the internet industry. I think that actually presents a long-term good opportunity, but some investors may not. I also think the other companies in our portfolio, say Shopify and C Limited, who are also at a very healthy allocation, about 16-17% of the portfolio, are going to be able to overcome any of the drawdowns we see over time. Now, the companies you've never heard of before, you get something like a weight. I'm just making sure I'm working through on time here. And so if you heard that, the power of being digital cannot be understated. And if you look at this right here, the power of being digital means that you can create a free, perfect, and instant copy of something. The internet enables digital technologies. And so what you're going to see is that FDN and FDNI are pure play digital portfolios. Things we never knew that we would do we are now doing and take for granted because of the internet. Whether it's a digital solution or a physical solution, the internet has enabled exponential technologies to exist. And so that's the first D of the 6 Ds in exponentials is that. And that's where we come to here. So we can see if they put the new Star Wars movie out on iTunes, for example, you could see that they could buy 10 copies, or let's say iTunes could sell 10 copies or 100 copies or 100 million copies. It would cost Apple only what they had to pay to get Star Wars onto their platform. So a fixed cost. And then at some point, it's just a waterfall of cash. And so what we're seeing right now at companies like Shopify, there was a fixed cost to build out their platform. They've exceeded that. And now largely, as their sales are growing faster than their expenses because they are a digital business. They have 55% profit margins. Similar to other companies that are in the international portfolio like Spotify. In fact, now that Spotify has opened up this platform for other developers,
Greg.
Hi,
Greg,
I
your
lost a
audio
bit.
got cut.
yep, sorry.
Yeah.
Okay, perfect. Can you hear me again?
Yes, we can hear you now. Thanks.
Excellent. Sorry about that. Once in a while, I get that issue when I'm using too many different PowerPoint presentations. The point is turning fixed costs into free cash flow. Spotify building a digital platform, it has created this marketplace where other people can just fill it with content. And now they're starting to get organic content. It's unbelievable. It's like YouTube, right? YouTube was just a platform for videos, and now they're able to sell loads of advertising on YouTube simply because other people have created things. Other than pivoting to something like Disney or Netflix, which is purposefully building content, right? So they're creating things like Squid Games or The Crown and then distributing it globally. So it's unique, and the internet enabled both of those things. And when you get to something like this, you can see education, artificial intelligence, manufacturing, healthcare, energy, automotive, you name the sector, the next phase of our world is built on the internet, like it or not. And so when we take this, we use this as a history in breaking sector boundaries. I should have just waited for this slide. So there you see Facebook and Google were called IT stocks. Amazon and Netflix never were. And in fact, Amazon and Netflix were the two better stocks actually, in the end. And now none of them are tech stocks. In fact, if we go back to 2002, and then run this through the end of, just near the end of last year, this is IT, this is communication services. The point is, even now where it's 45%, it's never been all IT. In fact, it was barely IT from the beginning. It had companies that weren't even classified in the sector. The point is, a typical sector ETF person would have completely missed this. And let's all be honest on something. The internet is the most obvious theme in the world. It is the most, and has been for a very long time. It's not like we're trying to explain how we create green hydrogen. So the 10-year numbers, I think you all know of the internet, were just amazing. This is through 2019. This was the number I wanted to show you, though. So the 10-year numbers, pick a decade in this portfolio. They've been just fantastic. Obviously, you could look at one particular one from 97 to 2007. But if you look at this number, I hope you find this as staggering as I did. Okay, so we've got a 1,426% return for the Dow Jones Internet stocks. The S&P was up 453%. So inside one of the hardest 2 decades to beat the S&P 500, and in spite of a massive tech crash and a 2008 crash, and then even if you add in last year, it's only higher now, we've got 790 basis points of annual return, or 500 basis points of outperformance annually for 22 years, 23 years now. It's incredible. These stocks, again, beat the S&P last year by 30 or 40%. And so a lot of folks then say, well, surely there's no more opportunity left. No way. If we look at e-commerce as a percentage of total sales, I usually do this as a question, but just for time's sake, I've got about 20 minutes left. We've got the US, this is the United States, one of the biggest markets in the world, obviously, is just arrived at 15%. It crossed briefly to 16% last year because of the coronavirus, and we are absolutely back on trend. It's incredible. Who doesn't think this number will be 28% at some point in the future? And that's a doubling. That's a doubling. In fact, when you look at this number, the number of internet users forecast in the next couple of years, you're going to add another billion users to the internet. Anyone that has access to the internet is somebody that can buy something on the internet, whether they're in Nigeria or South Africa or Singapore or Thailand or Australia or the US or Canada or the UK. Anyone that has access to the internet. It's so simple, and it's something we take for granted that I stress, because it really goes to show how powerful this is to make money. The essence of making money for any company, whether you're a tech stock or an industrial, is selling something. Companies like Kimberly-Clark, they sell toilet paper. They have to sell toilet paper. They make toilet paper and they need to sell toilet paper, and it's easier to sell toilet paper on the internet. Now, look at this number. And this was published, I believe, yes. So this was published just after the coronavirus. Sorry, I have to move my little window here. All right. So what we can see here is that in 2020, we added about $1 trillion. So you see, we had gone from 1.3 to 3 trillion. So that's about 2x through 2018, added another 10% into 2019, and then added effectively 33% into 2020. So then if we go back to, say, a 10% growth rate, you're seeing that right there, right? Maybe a 20% growth rate. The forecasts for worldwide e-commerce sales from here to here are an extra $1.5 trillion. That's more than the entire cloud computing market. And this is just e-commerce, as they tag they call e-commerce here effectively online shopping. I'm going to broaden it for us because I think it's much bigger than online shopping. But inside this, they're only talking about online shopping and the e-commerce sales. And when you're looking right here, 4.9 trillion to 6.4 trillion, roughly at 50, 60, 70% profit margins too, because these companies are digital businesses. Now, outside of China, since we found this out, but the UK is the largest country in the world as it relates to e-commerce, and largely it's because they don't have car parks. It might sound silly, but it is a very big reason why it's a lot easier to just buy things online than go to the stores, because you can't park anywhere. And that's very similar to the rest of Europe, which is why we believe Europe to have quite a growth opportunity there. So only 25, 30% of UK is online. Who doesn't think that's going to be 40 or 50%? Now, here are some of these other future trends. We've got the increase in mobile shopping. Personalization of the entire process is the more they know about me, the more they can target market to me. I can get information about being a New York Jets fan, which is a horrible thing, but it is who I am. And I love the Jets, and I love anything that's green and white and is about football. The simplification of checkout and payment systems. And hear me really clearly. In spite of the reopening trade, Shopify has a brilliant model that syncs your e-commerce and in-house checkout opportunity. So some of these businesses are clearly entering a phase that's going to start changing the world. There's more experience shopping, where you're going to want both a dynamic internet presence and a dynamic in-shop presence. Some people will want to come to your shop. Some people want to buy online. Some people want to do both when it suits them. You can just ask Alexa to buy you goods. Sustainability and e-commerce, because you don't need as many buildings and because you don't need your logistics warehouses to be inside the city, you can be, say, outside the city, powered by renewable energy, driving electric trucks to drop them off, powered by social media, allows a much better target marketing, and AI is going to continue to improve the shopping experience. When you pivot to this is something we wanted to say. So this is the e-commerce all-stars. You've got, in the US, you've got Etsy for clothing, eBay as a great online marketplace. Of course, you could have Amazon, PayPal, Pinterest, Roblox for gaming. That is going to be there in the Internet Index. Outside the US, you've got these other companies. I'm not even going to try to pronounce some of them, but you all know some of those, I'm sure. Afterpay led the way in what's now becoming this Afterpay revolution. China's for sure leading the way. They've got 8% forecast annual e-commerce growth over the next 3 years. China has leading the way, but the other countries around the world, rest of the world's at 6%, the US is at 6%, and there's Europe above the US. That's exactly my point. They don't have parking lots. But it's not just e-commerce, and here I mean online shopping. What is digital beta? What do you get in an internet portfolio? Yes, you get online shopping, but you also do get social media. What is social media? Well, it's enabling that online shopping. In fact, some of the social media platforms are selling you things over the platform, like Instagram. Cloud computing enables the web to stay open. It enables some of the, again, things we take for granted, like taking delivery and payment information and showing you your shopping cart. That is cloud computing, like Shopify and what Alibaba does. Obviously, there's other forms of cloud computing, but those are internet-based businesses. In order to do online shopping or sell anything over the internet, you need mobile payments. We also have music and video streaming services. Business intelligence, unbelievable thing in terms of commerce. So Salesforce.com is a brilliant example of this. Now, I just want to show you this. Think of these things that we never, ever, we literally tell my daughter, do not get in a stranger's car, right? And now you just push a button, you get in a car and you get out. The number of people that bought a home without even looking at it last year was something in the area of 47%. Crazy. Who would do that? Who would buy a house without seeing it? Well, the internet made that possible. It's kind of an amazing innovation. Doing a meeting virtually. I've been saying for years, why do they not have these cloud computing or these climate change meetings over Cisco WebEx? Yeah, Al Gore owns part of Cisco. I think he's on the board. 20 years long, I feel like they've missed an opportunity there because they always fly from all over the world into this one location. Anyway, we can do that. Then you got pay for good. Now this one to me takes the cake for what could happen in the future. Okay, and this is why you buy a thematic ETF. We know the internet changes the world, but we don't know how. and neither do active technology managers. You never in your wildest dreams 15 years ago would have agreed. Even so, 15 years ago, we're still in 2000, we'd be in 2006. Okay, so right before the iPhone. There's no way, we all know what the internet is in 2006. There's just no way anybody would think someday I'm gonna go stay in somebody's house while they're in there. I'm gonna sleep in the back room of somebody's house. But then Airbnb makes that happen. It makes the sharing economy and this more sustainable economy together. So now I'm gonna start skipping forward. The forecasts are just off the charts. It's trillions and hundreds of billions everywhere you look. The number of users worldwide, you've got Facebook, YouTube, then you've got WhatsApp, Instagram. Obviously, these three are all owned by the same company. Then you got WeChat, oh, same with this one. Then you've got WeChat, TikTok, QQ, you got social networks over here. You could see just worldwide by region. So which one is that big one? Eastern Asia there, just a huge chunk. Western Asia, Southeast Asia, 13.4%. You're coming here, you've got different websites that get monthly billions of views. And we can see, I thought this was interesting. That is how much is that? That is a 1.5% in our internet index. Not a lot of people own that company. And yet it's one of the top monthly website hit views worldwide. Twitter is a stock people have stopped talking about as well. Now, when you get here, you see mobile payments. And I'm going to speed up so that we can really hit into the actual companies themselves. And I think you all know this, the dominant players in mobile payments are Alibaba and Tencent. It's another reason why I think long-term, these digital trends are not slowing down. And a couple $1 billion of fees here and there are not going to slow down the trends at all. But in the near term sentiment, you got to take what we're given. And it's been a heavy dose of medicine the last couple of quarters. When you're looking at the subscription economy, a lot of people talk about this. The thinking about where to go get a subscription business, and there are subscription thematic trends, but if you just look, this is in our international portfolio, in the portfolio, in the international portfolio, in the portfolio, in the portfolio, and you start looking, big companies that have these streaming options are in our portfolio. I'm surprised. This is just for music, by the way. Then you've got Disney and Netflix. Cloud computing is taking the computer and scaling it over the internet. You need more computing power, you get it. You need less, you get less. It is the backbone to the future digital transformation. Just the Internet of Things, McKinsey says, is going to be between $4 and $11 trillion of economic value by 2025. Folks, that's 3.5 years from now. Just over 3 years. Continues to have cord cutting. Right now, we've got in the United States, according to Netflix, there's still a 30-40% market share of cable networks. Cable networks cost a lot of money. And because of the internet, you're getting more and more and more of these companies are just going direct to consumer and allowing you basically to build your own cable network. And in fact, we also pivot here to the video game industry. What I'm walking you through is whether it's the domestic US internet stocks or the rest of world internet stocks, you're getting exposure to all of these themes. Video games is part of e-commerce. If you think of shopping, you think of a mall. I always went to GameStop when I went to the mall because they are a video game company. There's lots of video game stores in a mall. Video game revenues are bigger than film, music, and television combined. And now a massive percentage of the money flow is done in game through the internet, right? Oh, you're having trouble beating this monster, you buy a special axe, there you go. And so that's one of the reasons why we wanted to talk to you about that. Then there's business intelligence. This is just a look at the Salesforce sales cloud with DocuSign actually embedded into their system. I don't know why it's grayed out there. Sorry about that. At the end of the day, I just wanted to finish this. We like to tell people for thematic investing, look to your own life, so anecdotal evidence, and then marry that with sales growth. If you can look for anecdotal evidence, excuse me, and marry that with sales growth, you'll make really good investment decisions. Think about if you bought Netflix or whatever your streaming service is. I might not know what it is, but if you bought your streaming service, when you first heard about it and checked to find out if their sales growth was doing really well, right? And then you move to profit margins and cash flows and earnings per share. But if you just look at this, this is just the FANGS stocks. And I personally do one of these 15 things probably every 5 minutes. Okay, probably every 5 minutes. So how does the Dow Jones, owned by S&P, one of the most famous index companies in the world, how do they put these two portfolios together? They do the 40 largest liquid names that get over 50% of their revenues, market cap weighted with a 10% cap, quarterly rebalance. The 40 largest liquid companies, market cap weighted with a 10% cap. And we see for the first 3 quarters of the year, this 10% exposure to Google was an absolute home run. The S&P has a huge exposure to Google, and it's only 5.85%, as you can see right there. 52.54% return. And that's allowed us to generate 164 basis points of outperformance there. Not a lot of people talking about Snapchat, and I don't know anybody talking about Datadog, and they're not even in the S&P 500 yet. Snowflake is not in the S&P. Cisco is only 62 basis points. eBay's had a renaissance this year. They're only 12 basis points in the S&P 500. Salesforce.com, as we just talked about. Now, Zoom has had a bad year, and here's the downturns. Even on the downside, though, I simply want to highlight, look at how few companies are in the S&P 500. And so when you look at fundamentals, it's just off the charts what we're looking at for either historical or forecast growth, crushing that of the S&P 500 and even that of the more broader technology indexes. Then when you look here, we can see an absolute total return. This is now over 3 years. The only reason the alpha of this particular index is higher is because Microsoft and Apple are about 40% of that index. But in the longer run, as you saw earlier, our outperformance is completely dominant. So as of September 30, we just thought it'd be important to show you broadly, you're getting online healthcare, huge trend. Then if you just look here, you're getting a bunch of companies, some that you know and some that you don't know. So you might know these two. They're just internet providers. Arista Networks provides Facebook with data services. So think about this. If you want a low-cost way, not a low-cost way, a potentially less risky way to profit from the metaverse, you can buy the company that's providing that company with data services. That's a good business today. And then if Facebook does do the metaverse really well, then they're going to be using even more data. That's the US internet portfolio. And you can see what we do every quarter. Themes are dead unless they actually turn sales, turn the theme into sales, and then turn those sales into profits. What we do every single quarter, we wait for the quarterly earnings report to conclude, and then we take the weighted average sales growth. Now, I just want to point out that is exceedingly high right now. It's actually more like 17.5%. It's just that they had a good Q2 over a terrible Q2. That's all that was happening right there. But look at this Dow Jones Internet Index. It's growing about 2 to 3 times faster than the S&P 500 at about 2 times the profit, with twice the profit margin, or 1.5 times the profit margin, at about 2 times the price to sales, with faster earnings per share growth. Here are the 10 fastest growing companies as of the most recent rebalance. We've got, again, online travel reopening, selling for Christmas. We've got social media. We've got online healthcare, cloud computing, social media, selling for Christmas. We've got selling homes online. We've got cloud computing. You all know Google, and cybersecurity, all in one portfolio with very little exposure from the S&P 500. But then we can move to the international market. You all know about the FANGS stocks, and you all also know about Alibaba, Baidu, and Tencent. In my last 10 minutes, I just want to highlight how far Tencent and Alibaba have already come, because it is mind-blowing. Google is widely considered one of the most innovative companies in the world, and they've gotten about 1,000 patents a year with a brief stint up to 3,000. Okay, about 1,000 patents a year with a brief stint up to 3,000. Tencent's been over 2,000 every year since 2011. Unbelievable how many patents they have. Amazon Prime, talking about Cyber Monday, Amazon Prime on Prime Day got 10 billion in sales last year. I think this year they got even more. They got 11 or so, although they moved it around. But last year they got 10 billion in sales. And this is this year, 11 billion. There we go, 11.2 billion in sales. Sorry, they just updated that for me. The merchandise volume of sales for Alibaba on Singles Day was 75 billion. 75 billion. Singles Day, another made up day, just like Amazon Prime Day. It is not just Alibaba and it's not just the US. So here's Alibaba, and I think they also own that one, Suning. So that's 62% Alibaba, but JD.com, 26%. Looks like you could get shares from them as well in that free giveaway you got to participate in. But notice that it is 20% of the UK, Netherlands, and Germany, and 17% of France and Belgium are already aware of Singles Day. Aware of means they can check that and purchase if they want to. So think about that. I'm going to skip Baidu for now. Alibaba, I know you all know Alibaba, and so let's just move on to this. Again, the 40 largest liquid names that get over half their revenue online, market cap weighted with a 10% cap. The 40 largest liquid names that get over half of their revenue online, market cap weighted with a 10% cap. Yes, it is 40% China. Let's just sit on that for a second. It is what it is. There is no way I can confidently tell somebody to buy a basket of internet stocks without saying that they have to have a piece in China. That's just the way it is. It would be like 6-7 years ago if somebody said, I don't want to own Amazon and Netflix, their valuations are crazy. Yeah, but I can't give you a basket of internet stocks that doesn't have Amazon and Netflix. It's just not the way it works. Rules-based investing forces investment by the rules. The rule for this is simple. Do they get over 50% of their revenues online? Are they one of the 40 largest that do so? Market cap weighted 10% cap. Now, on this, 10% is in Alibaba. About 15% or so is in Tencent, just because some of you know that Prosus and what's the South African one, Naspers, also own some of Tencent, but it's not that simple. They're not just the business. So they do have their own businesses down there. So I wouldn't overcomplicate that, but I do want to highlight that. Now here's one thing I'd like to point out. Let's just do a bit of portfolio math. 0.6% of my portfolio equals, and 0.4% of my portfolio does what? And equals. So China looks like a pretty good opportunity. However, it's seriously depressed. And that's what's giving the opportunity, although it does signify the market potentially thinks it's going to go even further down. So I'm going to assume there's another 25% drawdown in Chinese internet stocks. Alibaba just reported and their e-commerce market grew 30%. That's the most recent number. They just reported November 18th. Stocks down. They got fined again. They had some extra expenses, from what I gathered, mostly due to their content platform where they're competing in something like a Netflix. So let's assume this goes down by 25% more, right? Well, I think you're going to know the math. And if this goes up by, say, 300%, it's pretty clear what that math is going to give us, right? So if over some time period, we get a 0.4 times 0.25, that means we're going to, 0.4 times negative 10%, right? And then 0.6 times 300 is plus 180%. I think you're going to be okay with 190% return. I'm not saying that's going to happen. Past performance is no guarantee of future results. I'm doing some expectation math here. The history of the US Internet Index was up 4,000% over a 23-year period, did extraordinarily well. And The international index here, this particular portfolio was up 80% last year. And I'm going to show you something in a second when we look at how their companies are reporting. So whatever we expect, if we expect this to lose, but this to gain, I still think the gain is going to be better than the losers. And I only have to point to the US history of the tech bubble, where the losers clearly were there. We all know that there were a ton of really bad, big US internet stocks, and they still had a positive return. Now look at who's driving the ups and the downs. No surprise here. These are all Chinese names. Again, Naspers and Prosus own or have assets in Tencent stock. So no surprise there. No surprise there. Kind of a fascinating thing. This, by the way, is just because they're either not in there or it's not holding the ADR. That's a simple thing to be aware of. Now, when you come up to the top, notice C Limited, number one. That's why I told you in the beginning, I love that business. Atlassian, great cloud computing company. That's a great cloud computing company. A UK stock right there. Adyen, a German, it's a Dutch security that does fine. It's like a Dutch PayPal. There's that Russian Google. There's South Korea's Google. And then I don't know what that company does, but they've helped the portfolio this year. So you can see here's a bunch of companies that have done well. And here's a bunch of companies that have done not so well. And they're just not in the broader market. When we come here, we can see very, very clearly that the top names here are now growing even faster than the US internet. But because, so remember the US internet portfolio was at 43%, and here we're at 57%. But notice because of the Chinese avoidance hangover that the market's feeling right now, you're getting it even cheaper. Remember that it was about 7.6 was the price to sales on the US one, with a very healthy earnings per share growth. And now here's where I just want to land on this point. Then we'll open it up for questions. This has nothing to do with the stock performance. And remember, this is for the quarter that includes the months of August, July, and June, and maybe May or April. April, May, June, July, August, depends on where they come up with their fiscal years. But as of September 13th, this is when I drew the line in the sand and looked at what their most recent quarterly earnings report was. So those Chinese regulations and the fines and the anti-competitive things, they did not start impacting the business by and large until after this. And so to see that the top 10 fastest growing companies are by no means dominated by China gives me even more confidence in what I just talked about. So this, as you know, is a Singaporean company. That is a German company. This is Chinese. This is Chinese, but not Alibaba or Tencent. There's Russia's Google. This is Chinese, also e-commerce. I forgot what that one was, but I don't believe that they are Chinese. Let me see if I can tell you real quick. I do not know that one. Maybe one of you do. There's an Australian security, Dutch Wirecard again, and stock. Phenomenal. All growing 60% or more. All from a radically different group of internet stocks. Now, before the last drop happened, Alibaba's PE was cheaper than Unilever, and they'd already lost $1.2 trillion. So it sure looks like the underlying opportunity, especially for companies like Meituan, Pinduoduo, and JD.com, look really, really good. And now these numbers are much more like 30, 30, 30, because they just announced, and their PE is back around 17. So I still think, all things being equal, long-term buy, it looks like they're a good investment, but you have to acknowledge the political risk in China. One other thing, digital adoption is accelerating. Most people think it's going like this and then hanging out for a while. Whereas I really, really think if we were thinking about this, I just want to double check. Yeah, I have not shared this slide with you. This is really important. So this is the CEO of Microsoft. And here's what he said. Over a year into the pandemic, digital adoption curves are not slowing down. In fact, they're accelerating. I do not believe the market believes this. I think most people think Digital adoption was going. We had COVID, and then it's right here. We're reconciling what we're going to do moving forward. He's saying it was growing like this, then it started growing like that due to COVID, and now it's starting to grow like this. Nothing's drawn to scale. I'm just trying to give you an example. And we can see that over half of the products worldwide are now going to be digital. We do not know what that next thing is in the future, but we're pretty confident if it's a digital portfolio or digital opportunity, it will be in our portfolio, the Dow Jones International or Internet Index. I wanted to show you this. This is about going global. A lot of people reference Alibaba as the Amazon of Asia. You all probably do not, but a lot of people do, and it's just not true. Alibaba is the Amazon of China, which is not a bad business. For the moment it is, but in long run, we don't think it is. Sea Limited is the Amazon of Asia. Look at that. They do video games, streaming content, mobile pay, and of course, e-commerce in Indonesia, Thailand, Singapore, Malaysia, Philippines, Vietnam, Brazil, and mainland China, all over 4% of their total revenue. Very diversified business from a regional perspective. The last bit, I think this is the last slide I have. The last slide here that I have is to show you what pull forward demand does look like. So here you can see 2017, 18, 19, and this is important because this is 5% of the FDN, and this represents a healthy concept in the international strategy as well. You can see that the pandemic brought forward a bunch of people as they were working from home. So any gap between here and here is pull forward demand. But I have to be very, very clear. They didn't go like that. So people didn't jump on their platform because of last year and then sell it. They still own it. In fact, they're still forecasting to add 10 million subscribers. Their profit margin has increased fivefold from 4 to 20, in spite of the fact that in 2016, they spent $6 billion on content, and this year they're spending 12 or more. So they're spending more money and have 5 times the margin. I know physical businesses technically can do that, but digital businesses can do that by and large, either just in general or a lot more than a physical business. And the last piece, again, even Netflix, just to look at their growth opportunity. 40% of the market's still cable. This is according to themselves, by the way. They think they only have 7% market share. Amazing. Could that jump to 14? Sure. It's just above YouTube. It's amazing, the content. And there's a lot of competition in this market. But the element of being digital means that, and this question came up yesterday, are there just going to be so many streaming players that come out? I think what you're going to see worldwide is very similar to the Coca-Cola and Pepsi market, where you're going to have Coca-Cola and Pepsi in every market. So let's call that Amazon, Netflix, YouTube, Disney Plus, right? And then you're going to have your local market. So in the UK, Jasmine and I know they've got this ITV thing and BBC Player, but nobody in the US knows about those two, by and large. Nobody watching that. Probably not a lot of people in Germany. In the US and Germany, and where you live, you're probably watching one of those and your own local one. And we believe that that's going to happen moving forward. Okay. I'll just stop right there. I think I went 1 minute under. So I'm happy to take any questions you have. And I'm just so thankful for this opportunity, again, to talk about the ticker symbols of FDN and FDNI. Oh, sorry. Not the International Internet Index and the Dow Jones International Internet Index.
And Greg, thank you for the very comprehensive presentation. We currently have only 2 questions actually. So the first one is actually from Haresh. Okay, he asks, you spoke on Alibaba and Tencent with huge opportunities, but the stock is down. What are your thoughts on them and China tech companies going forward? Perhaps maybe you could revise and go through. Earlier you mentioned something about the 25% hypothetical drop in the Chinese stocks. Maybe you could go through one more time.
Yeah, absolutely. So I think it's kind of simple math. An easier way to think about this, actually, a simple way to, it is just like you would think about your global portfolio. So if the US were to drop by 10% and your European stocks were to rise by 15%, what would happen to your portfolio? So that's kind of how I've approached this. Now, we have to admit the Chinese names have come off very, very strongly. And again, the Dow Jones International Internet Portfolio and the Dow Jones US Internet Portfolio give you exposure to companies. Some will do well and some will do very, very badly, right? And so year to date, I believe Alibaba is down something like 40, 45%. Does that represent an opportunity? I think it does, but until it does, it won't. That's value investing, right? That's actually value investing. But if you look at the underlying business, their growth rates, which they just announced here, I'm going to pull it up and show you. Or, well, I'm not going to show it. I just want to get the number exactly right. But to say it that when we're talking about valuations, that Alibaba is currently sitting with a forward PE of 16. Amazon's is 60. Just so we're all on the same page there, Amazon's is 60. So let's see here. Where was there? Right, here we go. So by their different platforms grew, their total revenue grew 29%. So that's their total revenue. And let's see if they did a breakdown for me here. Yeah, we go. And then each of their underlying platforms grew about 29 or 30%. So their commerce platform, their e-commerce, and their cloud computing all grew between mid-20s and 30%. So if they do that again next year, or even if they grow 15%, this is over last year's numbers. And if they're already at a forward PE of 17, it just means that, or 16, it means that in the future they'll be even cheaper. But what if this goes down, right? So here is the math: is I believe the Chinese opportunity is quite high, but you can't ignore the political risk and assume possibly this just loses you money and stays here. So two things come up. If this loses another 20%, we just do it let's do it a different way. We take 100, 40 of it drops, right? So 40 of it's going to drop, let's say 25%. All right. So that part of it is going to be 40 minus 25%. We're going to be left with 30, right? So 40 loses 25%. You're going to be left with 30. And then if this 60 that we've invested is going to go up 300%, that means you're at 180, right? And then 180 minus, well, actually plus 30, you're at 210. As your total value, you've more than doubled, right? And so that's effective. It's just simple math equation to walk through what could happen. And then another way to think about it too is that if these names lose, okay, this is the power of a market cap weighted portfolio. Let me see if I have an old slide that I thought was in here. And if it's not, I'm going to go get it really, really quickly for you to show you the historical exposure in the US internet portfolio. Give me 1 second. But maybe queue up one other question, because what I'm going to do is showcase the historical holdings of the Dow Jones Internet Index in the US about 10 years ago. And what that will show is pretty interesting information about, here we go. I think it's right here. This is the other thing that could happen to China. It would be a one-off impact on your portfolio, as it would then sink lower and lower and lower in your underlying presentation. So sorry. If you have another question, I can answer that while I'm looking for this one slide.
So just to fill in that time. So Helen actually asked, what ETF do you recommend the viewers to purchase into?
Out of these two?
Yes.
Yeah. Honestly, I think a blend would suit. But if I had to pick one of the two, I would likely go with the international one. And the main reason would be you do have a healthy exposure to the FANGS stocks likely in other parts of your portfolio. And it's a guess, although you might have healthy exposure to some of these stocks as well in your portfolio. So I think that'd be more about the underlying person's portfolio. I'm obviously thinking from a more Western portfolio is going to have quite an exposure to Facebook, Amazon, Netflix, Google in their portfolios already, PayPal, Salesforce.com. You tend to see those in the growth portfolios. Here we go. And that's why I would say to get companies that you don't own, to get more companies you don't own, I would recommend that. But you also can't it's really tough because you don't want to ignore the American innovation side. And that's one of the things that it really for me would be to say 50-50. But this was the slide I was looking for. So the other answer to what if there are things that are overvalued or lose money, if you go back here, I mean, Juniper Networks, let's see, Booking Holdings, how many of these companies are amazing companies today, right? Versus as we can see them over here, we see these are much more representative of the sizable, strong companies at that point, FANG plus eBay and Twitter and VeriSign. And some of these companies just went down over time. I don't know exactly about Juniper, but that would be what I would think about Alibaba and Tencent. If they continue to decline as the others grow, then they'll just continue to occupy a smaller percentage of the portfolio over time. But I don't think that's what the Chinese aims are, is to lessen their impact of their tech behemoths. But I do think they're looking for some short-term pain for long-term gain, but we'll see if they allow the international investors to get back in there soon.
Thank you, Greg. I think that more than answers the question. It was a very comprehensive answer. Okay, before we end off the webinar, okay, I believe that would be all for the Q&A session. We actually had 3 questions today only. Before we end off the webinar, okay, I would like to invite the audience, okay, to take a short survey, as well as perhaps join our Global Markets Telegram channel. Give me 1 second. And I would like to thank Greg for the very wonderful presentation that we had today. I think I learned a lot as well, given that I'm pretty junior at Asian stocks or ETFs in general. So I would like to thank you, and on behalf of Phillip Securities as well, thank you for joining us this evening. I think we have come to the end of the webinar. Please, if the audience could, we would like you to take a survey. It will help us to continue to improve and provide content that you feel is relevant as well. Okay, thank you.